Okay, so welcome back to our mentorship program. Today is Wednesday, the 20th of September. So today's our day 2 class, and we are going to be looking at order flow. Sorry, we're going to be looking at order blocks and fair value gaps in the market. Order blocks and fair value gaps in the market. So yesterday we talked about market structure and order flow. And let me quickly share my screen. Okay, can you see my screen?
Yes, clearly.
You can see the Forex screen, right? The trading view.
Yes, clearly.
Okay, beautiful. So we talked about market structure yesterday, and we said that market structure is understanding the entire structure of the market. That is where price is normally headed, and where orders are, where the institution are carrying the flows of the money to, like price. And this is Australian USD, that's Australian dollar to the US dollar. And already from this market structure, you can see that we are bearish because price is making a series of lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. And we also said that within a high point and a low point is a range structure where you have internal order flows. So that's why in this high to this low, we can see this as a range where we'll be looking off to take a trade off of, right? So today, we are now going to look at order blocks, and we're delving right in. So I want you to pay close attention, and once again, I also beg that whatever understanding you've had of retail trading, have an open mind here when you're learning smart money concept, because most of the time it goes against the normal algorithm that you have placed on the market. So now we have established market structure, and we're going to now ask ourselves, what is order blocks? If we can see from the chart here, this is a swing point to a swing point. This is a swing high, a lower high to a lower low. This is the range between this high and this low. So at what point here is the market looking to react from, right? To go and take out the new low. Because we have this range here from this swing point to this level where it was broken. So this was a break of structure here, right? So at what point in this area is the market looking to react on and then break this low here? This is a break of structure. This is a break of structure right here. Okay, so before we go back into the chart, let's go and understand what order blocks are. So what is an order block? An order block refers to specific price areas with large market participants, such as institutional traders, have previously placed significant buy or sell orders. Clusters of orders are present in these areas, which have an impact on price movement, liquidity, and market sentiment. So in short, what we are just saying is that order flows are specific areas in the market whereby we have large volumes of orders. It's like when you place an order on Amazon to buy something now, and let's say that the thing is not available at the time, so you just place an order. Everybody's placed, like the iPhone 15 that is coming out now, it's not available yet, right? But people are already placing orders. So you find out that it's the people that have the most earliest order and at a very good price that will likely get the iPhone 15 first. I don't know if that makes sense. So this is just where order blocks are just different areas in the market whereby different, either if you are buying, where different buyers have put their buy orders, or in the case of sell, where different sellers have put their sell orders. Are we clear up to that extent?
Yes.
Good. So remember, like I said, smart money, the way we are teaching it is about you having a thought process. It's about you able to build a thought process. It is basically not about the strategy itself, but it's about a thought process in normal economics and finance. So we have order blocks, and we have them as places or areas in the market where there are large pile of orders. Now, in determining order blocks, as I said, within this high and this low, these are orders. Everything here is a structure, right? Remember, I told you every candle signifies a structure, especially when you're looking at it from a higher time frame. Every one candle in 1 second time frame has structure there. Then from this range to this range, there are orders here. There can be orders on this candle. You can find orders here that you look at it from a smaller time frame. All to the top, there are orders, right? So, do I go ahead to hold on just a sec? Because I want to teach this together with fair value gap. Remember, in the learning outcome that I sent to your emails, I did not indicate that we'll be taking fair value gaps today, but I think in order for us to understand order blocks very well, we must teach it together with fair value gaps. So let's just learn what fair value gaps are, then we'll try and fix the two. I'll try and explain the two on the charts, right? So now, what are fair value gaps? I'm sure you must have heard this saying, or FGV. Fair value gaps refers to the difference between the current market price of a currency pair and its fair value. So the fair value gaps are basically caused by market sentiment. Most time it is institutional, like it can be from fundamentals, especially. You see this move here, this heavy candle move here. It's an institutional. That's why they say that the banks are coming in or something. It's like institutional order flow, right? So because of the heavy discrepancy in the price or on the money that's coming into the market, it pushes price down heavily, thereby causing a gap. All right. And now these gaps, they are considered fair value, meaning that at a point in price will likely come back to fill in those gaps, because a lot of orders are placed within this gap here, right? So price would need to come back to fill it at a particular time. To get a more precise definition, let's see. Okay, we said this gap is a result of various factors that affect the currency market, including economic and political events, market sentiment, and market participants' behavior. So more often than not, we'll also always see that price, when it causes a fair value gap, price will always likely, not all the time anyways, but price will always likely come and fill it so that it can continue moving in a particular direction. Okay, so now let's look at the chart and explain. So like I will always do, if we have so if we have the market making series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? What we expect normally, or what we see in the market, is that each time the market makes a high and makes a higher low, and then there's a break of structure. Whenever a break of structure happens from the previous high, this is the previous high, this is new high. So each time there's a break of structure, what we can anticipate is that the price is going to do what? It's going to reverse back into this level to now fill in either a fair value gap or pick up a new demand zone from there. So more often than not, what we want to see is something like this. We want to see, hold on. So we want to see an order placed somewhere around this area, right? This would be where ideally our order block might be, and I will explain why. I just want you to first get the concept, right? Just get the concept. So also on several other occasions, we also see things like this. This is another low taking out this high, and then we may have an order here again. Then price may likely come and do what? Fill this order and continue upwards. So this is just the idea. Now, what I'm going to explain to you now is how then do we spot this order? How then do we know that this is the place where price is going to come to? Let's say that price was trading around here and then our order is here. How are we, well, I won't use the word certain, but I will use the word, how are we speculating? You get, most people say Forex is gamble, is guess. No, it's not. Forex is simply logic and mathematics and calculations and statistics. You just have to be able to understand it. It's logical, it's a thought process, and also it is algorithmic. Like it follows an algorithm that happens almost every single day. So you just have to be able to predict the market in that direction. So if our order block is here and then price just come all the way here and then take off here, we have already established the fact that more often than not, price will always get to your fair value gap or your order block. But it's not in all instances that it does this. But even though price were to come here now, are we now ready and prepared as traders to be able to get into the market at this area? So I hope I'm making sense. So the idea is to understand how we can take advantage of these areas where price is likely to retrace from, to go and do what? To take out this new high. Do we understand it up to this extent?
Yes.
All right, thank you very much. So now let's go into the chart so that I can now explain. Now, let us look at market structure once again. Now, this market structure, what is the direction of this market? Please, let's make it a bit interactive. What, Dolapo, you can unmute your mic. Let it be a bit interactive. I'll go back into my, so this is a bearish market structure, right? The order flow is bearish. So here we have a series of lower highs and what? Lower lows. This is a lower high. This is a lower low. This is a lower high. This is a lower low. Now, hold on 1 second, please. Hold on 1 second. I think I have a delivery guy at the gate. I'm very sorry about this. Hold on.
Okay, no worries.
Okay, I'm very sorry. Are we still here?
Yes.
Okay, let's go on. Where were we? So we said the order flow is what?
Bearish.
Good. We have a bearish order flow. The market making a series of what? Lower highs and lower lows. So we see this is a low, right? And then followed by this high. And then this high, it has this lower high. It took out this lower low, making a new lower low here. And making here a break of structure. So here we have a break of structure. Right? And this is the new low. So from this point here to this point, we have a new range. Let's zoom into that area. And now, how do we spot order blocks? This is the first one we're looking at. Order blocks are the areas of demand and supply that cause the break of structure. So in this our example here, this is the high, which is, let's say, the supply zone that caused this break of structure from the downside. So here we had this break of structure. So our order block will be seated somewhere around here, somewhere around this level to this level. Our order block cannot, a valid order block cannot really sit below this break of structure, right? It has to be the supply zone or the demand zone that caused the break in structure. And that order block is seated here. This candle here. Now, how then do we determine really that this is the order block and that this order block is valid? Now, for them to be a valid order block, in my own semantic of teaching, right? There must be there must be a break of structure, and there must be a fair value gap resting on that order. Now, a fair value gap, as I've explained before, it is an area of imbalance in the market that has or will be filled at one point or the other. Now, if we have 3 candlesticks like this, 3 consecutive candles following each other, right? Or something like this. Good. They'll have our wick here. We have our wick like this, and you know, let's take this one. Let's take this one down. Okay. Good. Now, these are 3 consecutive order blocks, right? Candlesticks 1, 2, 3. In order for us to be able to determine a fair value gap, we are going to be looking at the highs of these candles, that of the first candle we're counting, right? And the lows of the third candle. So we're counting 1, 2, 3. The highs of these candles and the low of this candle. More often than not, what we see is that candles of the first and the third always meet somehow like this, right? 1, 2. So you see that they meet at this point. Is that understood? But in a fair value gap, I don't know if are you getting me? Please unmute your mic so that I know that I'm following.
Yes.
So a fair value gap will be determined where this candle, the highs of this candle, of the first candle, does not touch with the lows of the third candle. So that's why we have something like this and this. So this area becomes our fair value gap. Here we come our fair value gap. Do we understand now?
Yes.
So from this market structure, from this range point, from this high to this low, we can see there is a lot of fair value gap here. We have this one here. We have another one here, a small one. We have another nice fair value gap here. We have a big one here. We have another fair value gap here. Good. There we have an order block here. Now, we have explained yesterday normally that from a high point to a low point, right? We always anticipate the market to move when we are pulling back. That's like we're retracing to now go and break the new low, or retracing to take out a new high. We are always going to anticipate price to move at least 50% into the market, right? Now, from this structure here, from this high to this low point, we can see that our 50% is placed somewhere around what here. So if I was to draw an horizontal line, let me just put it across the 50 here so I can take out the Fibonacci. I remember what I said. We are selling the market, everything we want to be selling at a premium, and if we are buying, we want to be buying at a discount, right? So from this 50% level, where can we see a fair value gap or another block? Now, don't forget, we're using a relatively big time frame, which is 2 hours. And from what I can see, an order block is resting here, Why? Because it is the block that caused this. If we look closer, we can actually see that there's an internal, likewise internal break of structure here, right here, or rather a change of character. Since this high took out, this was a change of character. So a change of character, to remember I said another block for you to determine it was break something. It's either it's causing a change in character or it's causing a break of structure. Now from this small view here, we can see that this market was ranging bullish, even though that this was just a retracement right to this level to take it down, but it was bullish at the time. And then we can see here, this was the first change of character within this small. Don't forget that the overall trend is bearish, right? But it doesn't mean that we can't see bullish movement. Now in this bullish movement here, we saw that this candle, this high, this supply zone was the zone that caused the change of character. So that makes here a valid supply zone, which is another block, right?
Yes.
Pushing it down forward, you see that it now breaks the real major, that's the 2 hours low, causing a break of structure because we're already in a bearish movement. So this is a break of structure right here. So this is the high that puts in this low, causing this break of structure. 50%, this is equilibrium here. So if you want to look to sell this market, you should be selling anything above the equilibrium, which is the premium. So we're selling at a premium and buying at a discount. So in this ordered flow that we're bearish, we should be looking to do or to sell at a premium. Now you may be asking yourself now, okay, from this 50%, now remember I said we'll start looking for other blocks, and the requirement for other blocks is things like what? Fair value gaps. Now if I take out this thing so we can have a clean chart, we have spotted 2 fair value gap. Now, one thing I do personally is that in finding my fair value gap, I look for the last, in case of bearish now, I look for the last demand candle, the last demand candle that caused the change in character of the break of structure. And here, what is that demand candle? Is this white one. Don't forget that demand is when you are buying, or let me just use the word, the last buy candle. If I was going for a sell, like this other block here, or let's say like if it was a bearish market like this, okay, we'll see now that there's a fair value gap, right? Okay, this is even good now because this is the last sell candle. A situation whereby we have like okay, something like this, 1, 2. I don't normally use this most of the time as my order block. I use this one here. I use the last buy sell candle to the buy. I don't know, do you understand that? So in this situation here, what do I use? I use the last sell candle here normally to the last buy candle to the sell that actually caused the break of structure. This will be my first order block. Second, if you look closely here, what can we see again? There's another fair value gap between here and here, and I love this because it's even it's a bullish candle here followed by an engulfing sell. So this will be another example of another block that I might consider as valid, right? Now this is a 2-hour time frame. There are so many confluences that have to be done when trading smart money concept, because I mean, if it were just as easy as putting a buy or a range and they will come and look for that block and sell, I mean, a lot of us would have been making billions while trading. You understand? So I think one of the best approach is first getting to a high time frame, map out the areas, put your zones, and then look for confluences that enables you to go into the market. So having now looked at this high to this low, and then we'll be able to spot this other block here, which has a fair value gap. If we also go to a smaller time frame, let's see if we can dig into smaller time frame within the area. Let's see if we can get there. Yeah, we should anyways. Okay, we're here. Good. Now you see what I have to zoom into smaller time frame so that you can get a more better understanding. Now this is a 15-minute time frame. remember that we had our high here and our low here, and then we marked this our OB. Now we mark this as our order block, right? Now if you look at
Yes.
this order block, you will also see that it made a high here. Let's see, it made a high here, followed by a low, followed by another high, then a break structure here. Now this is the difference between most time ICT traders and maybe what people call just normal smart money, because ICT normally trades off of fair value gaps, while smart money normally want to trade on the order block itself. Now the definition of order blocks may also be relative, just so that you know, because order block are traded in different ways, and different people have different ways in which they define and trade order block off. Most people's definition of order block is traded based on their level of risk. So why people like ICT himself would trade the fair value gap, other traders may only wait for order blocks. In this case now, if you see that this market now, this small time frame, I wish I can go smaller to make more sense, but I don't want it to take me back to the beginning. Let's see, where's the market? Can't even find the market. Oh, sorry. Let's see, I can drag this. Yeah, that's true. I want us to, because I really need us to understand what is happening here. Is this the place? Yeah, I think this is it. Why is it not showing me? Oh, okay. I think the best I can do is 15 minutes. Best I can do is 15 minutes. Anyways, we already itemized this as our order block on the 2-hour time frame, right? And from here, if we go into smaller time frames, we can see that there's a change in character from this small demand outgoing, small change in character. Now, what will happen is that this would be this area from here to here would have been an order block. If we were to refine it, if we were to refine this order, though it is from this point to this point, but you could refine this order block even smaller to maybe just be this level to this level here. Because to me, I remember I told you that I always like to use the last buy candle if you are going for a sell. So I'll use this high to this low as my OB. That's this point to this place where the actual fair value started, to this candle. This will be my order block. Now what we do here, we'll mark out this order block. Remember, it's above, it's resting at the premium level, right? So we'll draw this rectangle down to wait for price to come back and retest it or react to it before we look to get into a position. And what happened? You can see that price came all the way, entered into this order block. And what happened? It first came here. It came into it. Let's analyze it by ourselves. Okay, it came into it here, put a low, a high, lower low, lower high. What was your lower low here? High came, and then we have a change of character here. This whole level now, since we're using a smaller time frame, would now serve as another block. Why? Because we have a fair value gap resting here and here, right? So if we're to draw another order block here, we'll draw it from this level here all the way to this top. And then this is just for extra confluences. Most people just set their sell orders here, and immediately market moves into it, they are selling. But if you are looking to go, maybe you are looking for more points or confluences to enter into the market, this will be one. You look for a new fair value gap. But if you look at all here now, you see that there was no fair value gap that was not mitigated. Even this one here, this is even one. This But you see what? It was mitigated. So you could have actually opened your sell from here, right? Don't forget we said that for another block to be valid, it must what? It must break something. Because we are using a 15-minute time frame, if we go low to a 1-minute time frame, you'll see, or a 3-minute time frame, you'll see that there's this beautiful what? Order block area here. Because why? If you look, there's a fair value gap resting from this low to this high. So a trade, this is where this was taken out. So from this high to this low, we have a what? A fair value gap. If we were to draw a Fibonacci on that place, we'll see that it is above our 50%. These are 50%. Let me stretch that. This right here is our 50% level, right? So anything above here. So this would have been our order block right here. If we go to smaller time frame, we may see that there may be a white, it's like a bullish order, a bullish candle here, where we'll map our order block from. So in this case, we use this. Now my rectangles are so many, I have to start deleting some so that you can see clearly. Just give me a minute. So let me change this color right here to yellow, and then let me take out this. Okay, let's see first. Let me just take out all these ones. Okay, I think it's a bit clearer now. Hope you understand up to this extent.
Yes.
Don't worry, time is running out. We're going to go more in depth, but I need you to get the concept first. Now you can see that this order block is right here. We have another block resting here. Why? Because what? It's the lows of here and the highs of here do not meet. So that's our first requirement. Also, it breaks something. In this case, what? It caused a break of structure here. Already we had a change of character from this high to somewhere around this low. But we had a break of structure here. We have another break of structure here. So from this low to this high and to this low, we have a break of structure and then giving us a fair value gap. So normally one may want to set their sell position. I mean, if we're looking at this kind of small time frame, you could as well not be looking to take a trade off of the order block itself, but even based off of the low of this fair value gap, the way ICT does it. If ICT was to open a position here, it will look to open it at the retest of this high, not necessarily getting here, because in his point, the market does not always have to feel this, even though banks are somehow obliged to want to. But at most time, they always come maybe 50% of the fair value gap. We'll delve into the fair value gap more when we are talking in the next video. But I want us to first understand the concept. So if we were to look at ICT's way of trading, we would have opened our sell position from here. But I personally, I love to open my position somewhere below the order, below here. I like maybe like, some people do 50 of the fair value gap here. I like somewhere around here, because most brokers and their spread is wide. So I'll set my stop loss here. Now it depends. I'm going to be real with you. If I was trading this, I'm going to be targeting the low. If I'm targeting this low, this was the low that caused this high, I'll go and be targeting here. But realistically, if you go on the 2-hour time frame and you see that the market has started reversing from this point, normally you are to target the week's low. That's the 2-hour low. This is the right place to target, because don't forget, this was a break of structure. This high caused this break of structure. So obviously, we're looking at the high here that is going to cause this break of structure. So we're to target this low. But if I'm targeting this low now, my stop loss will not be this, refined. I personally now be refining this stop loss based on this order block here. So I would like to put my stop loss resting above this candle, even though my order block is from here to here. So on this trade alone, we could have gotten a 1:4.7 ratio. This will be our target, not anywhere here, right? This, because the market can as well come here or come to this order block resting here or somewhere here and then start going back up. So when you trade like this, what you want to do is that you want to be taking in partials. You don't want to actually wait the whole way. You want to maybe, once it comes like maybe 20%, you are taking in partials. I'll also explain why we need to take partials and all that in our class where we'll be talking on liquidity. We're talking about take profit level and taking partials, right? So normally when we see that this movement has already started occurring, we want to also be looking to take partials off of areas of maybe what we call liquidity. And I said that we're going to be talking about liquidity in our next, I think next week or tomorrow. So that's about fair value gaps and other blocks. Do you have any questions so far?
No. Yes. But just the rectangles, there were plenty.
Yes,
But I
exactly.
know how to take the entry from the fair value gap. So maybe I'll need to narrow down my knowledge to the several rectangles.
Yes. So okay, now let's just take more examples now. Now, fair value gaps, remember I told you there are areas of imbalance in price. And those imbalance, they need to be balanced at some point. So if we look at this area here, where we took our trade from, the area where we took our trade, or let's even go and look for an entirely different example. Let's use the 15-minute time frame. Okay, so what we're doing now, we're not really following any major basic structure, right? We're just trying to look for trades that have already been somehow, let's say, printed. Now, let's look at this area. Let's just do a top-down, sort of like a top-down analysis. Let's see. Now, we can see that the market is doing what here? It's making a series of lower low, higher high, higher low, break of structure here. What do we have here? Higher high. This is a relative equal high. So this is still this high. It's not broken. So this high now puts in this low. So what do we have? A change character. So we have a BOS here. We have a break of structure here. Hope my voice is clear.
Yes.
Okay, so we have a break of structure to the upside, followed by a change of character, a change in character. Remember I said I change in character is where we're changing from one character to the other, from a bullish character to a bearish character. So this is the first indicator that the price is going to start going down, except it takes out this high. Then it would have changed character again to the upside. That's why it's always good to know the overall market structure. The overall sentiment of the market is bearish. This is the low, and this low has been taken out somewhere around here, and this was the high. So when this price takes out this high, we can be very sure that the market is going to a bullish sentiment. But for now, until this low takes out this high, we are still bearish. So more likely than not, we can anticipate price still coming to play around here, only to get down and take out this low. So, but now let's just look at this from, remember I look at it with 4-hour time frame. So on the 4-hour time frame, where was the supply zone that caused the change of character? Remember I said that it must meet certain criteria. One, it must have a fair value gap. It must break something. This is a break something here. If you look at it from a lower time frame, this is also something it broke. This was a break of structure. This was a break, a change of character here rather. High, low, up, break. But since we're looking at it on a 4-hour time frame, this will we'll be using as our change in character. Okay. So this is the area. Can we see this candle here? We see that there's a fair value gap between here and here, between this one too and this one. So we have two, even between here and here. So you see that there's high volume here. There's a lot of sell momentum here. So definitely we must expect that price must definitely look for a way to pull back into this area, fill out these orders in terms of price, That's by mitigating it, because they call this unmitigated zones. So when something is unmitigated, we anticipate it to become mitigated. We see that price came and mitigated it up to here. So we now reduce each time. Exactly, I didn't point that out. Each time we have price coming up to fill those fair value gap, up until the point that it is filled, it limits the fair value. So like this fair value gap is from here to here, right? But we see that price has come here and filled up to this extent. So this fair value gap is no longer from this high to this low, but it will be from this high to this low. Do you understand that? So this is the remaining place now to fill in this market. Now, we also have this area too, here to here. But then what happened? We see price came in here, filled it completely, and then came all the way down. Are you seeing what the bank does? It comes, it fill it, it takes down. It comes, it fill it again, it takes down. Now this area completely filled up this fair value gap. And what happened? It came down. Now it may also interest you that if we had not seen price up to this extent, let's do this. Let's have a replay now. Let's see how we self can work the price out by ourselves. Now, this is real market conditions. Now, we may not have known what is on this side. So let's try and trade it fairly, okay? Now, let's say that this was where the market was trading off of. Where is our zone now? We have this swing point, this high here, which also is liquidity because we have a double top. I'll teach that in another class. And we have this low. One thing you must understand in this class I'm teaching is that many things may not add up to you just yet. But as we keep on going deeper into the class, things will start making sense. Take, for instance, yesterday's market structure. If I learned that only now, you may not have made too much sense out of what I'm teaching. But with adding it to other block and fair value gaps, I believe that you have started seeing changes, right? Right?
Yes.
Exactly.
Yes.
So it's all about having a thought process. So now, if we are realistically trading this market as at now, what do we see? From the 4-hour time frame, we see this high took out this low. I think this is one low here, if I'm even being high, low. See it now. This was actually the low right here. This. Because this high puts in this one, that puts in this one, that puts in this. So a change of character actually happened here. If we're looking at lower time frame, definitely we'll see this internal structure, but this is really the low here that caused this change in character. So if we're to draw a Fibonacci from here, this high point to this low point, where's our 50%? Right here. And you see that it's resting on what we call support level, because price seems to have tested or always reacted to this area. It has come and rested, and then it broke this level. So let's just put an horizontal line there. So we'll be looking for trade. If we are trading from the 4-hour perspective, 4-hour time frame, we'll be looking for trades that fall within, let's see what it looks like on the daily. We'll look for trade that fall within this, on top of this green zone, which is our equilibrium to premium, equilibrium to discount. Let me take out this fib. This is the daily time frame. Can you see how it looks on the daily time frame? On daily time frame, we can see that this price has taken out this low, putting this high. This is the last area of unmitigation now. This is the last unmitigated area. So if we're to draw a fib from this high, oh, sorry, that's wrong. If we're to draw a Fibonacci from this high to this low, this puts us just right where this other block is, because this is the last, or this is last bullish candle that caused this change in character here. So normally one will now like to mark there as an order block. Why? Because it has fulfilled two of the main and primary condition. It broke something and it left the fair value gap from this candle to this candle. So this is our order block there, but this is the 1 hour time frame. This is the daily time frame. So if we go to our 4 hour, what do we see? This is now we're now doing multiple time frame analysis. Okay, so on this candle, we see that this is the daily zone from here to here. It's our daily order block. So normally we can actually expect price to touch somewhere around here and react. that will tell you that it's reacting to the daily time frame. That's why most times if you are trading 4 hours and you then go and put your order block here and price come here and see, you say, oh, it missed my order with a pip. This also crystallizes the reason why ICT normally trades off of fair value gaps than order blocks. Okay, so if we were trading the daily, obviously we want to put our long position. If we are trading just from order blocks somewhere around here, and our stop loss, oh, this is that's for short. That's for, I need my short position. Sorry, let me take this out. We want to take our entry from around the equilibrium, since this is where the Fibonacci on the daily time frame says it's 50%, and put our stop loss just resting above this area, and then our take profit will be the low. Right, so it may come in here, tap it and go. So we're not trading daily now, because obviously, except you're an institution that has millions, you don't know how you want. This is a very wide stop loss that can possibly blow your account before you even start moving up 10 pips. So what we want to do is always to refine our entry. It's better safe than sorry. That's where I like to put it. So it's not like we cannot enter our position somewhere around here and know that bata is going to go down for some time. But no, we want to refine our entry based off of the account sizes and the risk management that we're employing. What can we see now? Where's our next order block? We have this one here and this one. Me, I've always said I like the last bullish candle before the sell. So this will be my order block, but it doesn't restrict this from being the valid order block, just so that we're very clear. This is my choice of analysis. So this normally is the order block here, because this is the low to this high. This is also a valid order block still, because why? It is also it caused a fair value gap between here and here too. That's this. Good. So have we understood it up to this extent?
Yes.
Okay. So
Yes.
now let's look at how and what price plays out. Remember that this is the new low we have. If price goes below here, we'll have another low. This is our 50%. So let's see what price does. Sorry. Let's see what price does. Good. Now, what happened here? We can see a first reaction. Don't forget that this line here to here represent our what? Our daily order block right here. So that you don't forget. And you see what happened? It touched the order block and what? It fell. It touched it and then it dropped. It dropped, and this has significant movement. I mean, relatively anyways, but you can't be trading a $100 account, $1,000 account using this kind of big order block as your stop loss. It's a lot taking. So what were we doing? Let's take price a little bit down. Can we? Let's go to 2 hours and see, because I want us to be seeing how the candle is playing out. On the 2 hour time frame, what can we see? We still see that the order block has moved to this one here, from this high to this low. So that's why you want to be using multiple time frame too, to keep on. Okay, if we keep going down to other time frame, you also keep seeing things. So that's why always for me, I always like to understand this point now. For me, when I see like that daily order block or the 4 hour, no matter how much we restrict the order blocks downwards, I will always keep this high point at the tip of that order block. You get, because if you look here, you see that everything here is mitigated. This is the first area that gives us a fair value gap between this one, that's this candle, and this candle, this candle, and this candle. So everything here, I'll just mark it as my OB and see how I can still refine it when price meets into that area. So it's not like when we put other blocks, we just wait. When the price gets there, we just sell. No, we just keep refining. At the same time, we're anticipating price getting there and giving us more confluences to actually go short. So that's that. So now let's keep seeing what price did. We know price has tapped into the daily order block. So let's see if it will respect it. Price has tapped into what? If you look now, price has tapped into our 2 hour, 4 hour order block right here. So let's just see. So normally if you had your sell open here now. Let's see if it would have been taken out just like that, or let's see if you would have taken some partials. So let's say we'll put our order somewhere around here, just a bit below because of our broker spread, and put our stop loss above this order block here. And then we'll be targeting this, say this was the low. We're targeting this low right here. Smart money will always tell you to also target the area of the last area of what they call it, fair value, like here, this area, because this is where liquidity is resting. But if we look on the smaller time frame, I also see liquidity may be resting from this one to this one here. So this is another area, because normally we'd always want to target the swing point, because why? It's not, the market always reverses. This could be the time where market comes here and then breaks above this high, now causing a change of character from the sell side market structure to the buy side market structure. So to be safe, one, he has said take partials. Always take partials around maybe some when it has moved like 25 pips, there you move your stop loss to your entry, so it's a break-even trade. Or you aim for the first area of good liquidity, which is like this fair value gap. But I don't want to go into liquidity now so that we don't get confused. Let's just understand that we'll put our TP somewhere around this same fair value between this high and this low. So let's see how this market would have played out. Okay, we're still in profit. I think this is a 1:3 ratio. So I mean, reasonably, if anybody was trading this from here, I'm sure you would have taken your stop loss to entry or to break even, or you would have taken partials here. I would anyways. So what do we have? You see that it almost tapped our TP. But come on, guys, let's be real. If we had gotten up onto this area where we can definitely see, that's why we're going to go into a lot. So don't worry, just follow. This is all liquidity resting here. This is all liquidity. All these highs are areas of liquidity to be taken, because when we are setting our profit, we are looking for liquidity to grab and liquidity to target. So these are liquidities to target. Already, price has taken out liquidity from all these zones. And then we are targeting, these are liquidities that are now being built. Buy side liquidity has been forming here. I'll be sell side. These are liquidities to be taken. Liquidity has been taken from all of these candles here, or here. All this liquidity has been taken. Then we'll target these areas of liquidity, which are in forms of fair value gap. And from this trade alone now, we have hit our TP realistically. So, but let's keep going. Let's see. Let's see. Okay, let's keep going. What happened again? We see price has come again and re-entered into our fair value, our order block. And what happened? If you had re-entered, you know it has entered before, you had re-entered, would probably have been stopped out. But you'd have been stopped out on the 4 hour, 3 hour, 2 hour order block, but not on the daily. If we are looking at the daily candle, we'll see that we are still well within our order block. That's this to this, that's this candle here. We are still trading inside our order block. I'm actually taking my time to explain this so that you get the multiple different things that can happen when trading this kind of market. We can see price coming. If we come into this area now, because you see this thing, I want us to now go into a lower time frame for confirmation. Say we are trading on the daily time frame. Let's say we're trading on the daily time frame and price did what it just did now. What would be the thing that will make you to get into the market from around here? Then what you want to do is to go into smaller time frames, because from within the smaller time frames too, you can also get good setups that can enable you to go short. So now look at this now. This from the 15-minute time frame. We can see the price making series of higher highs, higher highs, higher lows. This broke out this. Okay, now we have just about 6 more minutes. Let's see what we can do. We broke this level here. All right, so let's just wrap up this video because we're already at the end here. So remember we said on daily time frame, price is just sitting on our order block here. Price is trading, it's in this order block on the daily time frame. And we went down to the 4-hour, and we can see that price has nicely tapped into our 4-hour order block, but what? It stopped out, but it's still trading within the daily order block to go down. I see price is already here. That's why you don't just set your limit and expect price to just tap into it and then go down, except you are trading with smaller time frames within this zone. And that's what we're going to see now, because more often than not, price will definitely tap into your order block, come down a bit, and then go up. But then there are other indicators in the market here that is showing that market could possibly reverse. Also these weeks, and also the fact that we also have these areas here of liquidity. So price can actually be coming to pull up here, pull back, then take out this high, which is liquidity, take out this liquidity resting here, and to break out this place to completely change the trend to a bullish trend. But however, within these small time frames, you can see trade setups, possibly like within the 15-minute time frame. Within these areas, so you can see trade setups. Like I said before, we had a trade setup here where we bought around this place and then we got stopped out. That's because we haven't buying against the trend, the overall trend. So what I want to be doing is to be looking for sell setups within this area, because I know that this order block already is inducing liquidity, is inducing sales. A lot of sellers are here for smart money buyers. So I'm looking for sales using smaller time frame to trade. There are most people that their strategy of trading is just trading only 15-minute time frames. Most people like to trade 4 hours and then they will wait and all that. So, but it's a good trader uses all time frames to be able to identify where price is going. So now from the 15 minutes, or let's see 30-minute time frame. Yeah, from this 30-minute time frame now, what can we see? You see that price is still making a series of higher highs, higher lows into the order block. Now, even if we're to short, that's looking at the perfect thing, because what we're looking for now is entry, right? Even if we're to short this market, don't forget that price has come into the order block, but it has tested it before. It tested it here, it came down, we entered the position here, based off of just this order block here, and what? It came and it hit our TP, but we still see price coming back to retest the order block. Now, normally, if price comes here and retest it, it doesn't invalidate the order block, but more often than not, it is violated. So anything can happen. So you want to be extra careful to look for precision entries. You want to be precise about where exactly you want to enter into this market. Now, if I was on a 30 minutes time frame and I see this pattern forming a set of higher highs, higher lows, higher highs, higher lows, I'll be looking for the first change in trend, which is the first change of character. Now, this is the last low here. This low puts in this high, this low, or this low, anyone that puts in this high. So I'll put like a trend line here to be looking for where price will likely take out this place, thereby causing a change in character and validating another block for me. So let's speed this up a bit. So let's wait. Good. Okay, I need a body close. Good. So this is our body close here. This is our body close. So this is where we now have a change character. Just CH. Okay. Now the next we want to do, since we have a change of character here, where then can we see our order block? This was the load that was taken. So where is the supply zone, the demand zone that caused this change in character? Number one that we can see here is here. But what happened? It has already been mitigated here. So if you're trading a smaller time frame than 30 minutes, you would have seen an entry from this break of structure here, because then the character would have changed somewhere around this area, and then this would be a break of structure, leaving this area here where you see where price came. This was the low that caused this high. So you see price reacted to this and then came down and took profit. So that would have been one trade there. But since we are using a 30 minutes time frame, Where can we spot again? Can we see this now? There's this level here. There's this liquidity area. There's this imbalance here, fair value gap. So like I said, I always like to use this white candle. That's the last demand zone that caused a change in character. That'll be where I'll set as my entry. So I'll be looking for how price can retrace back up here. Then I'll likely be looking for a sell. I'll only be looking for a sell, don't forget, because our character has changed from bullish to bearish. Normally, some people like two confluences, whereby there's a change of character followed by a break of structure. Then they'll be looking to enter a sell from that first break of structure. I don't mind waiting. I don't mind entering a sell with the first tap here and then breaking structure. So let's see. Okay. Now we have a new low. This is our new low here now. If we have another low, we'll add to it again. So after determining that low, what will be the next thing you do? You have to draw out your Fibonacci. If it goes lower than this now, we have another what? Good. We have another. This now we have a break of structure. But wait, before that, 50%. As it retraced 50%. You know, this is smaller time frame, so I'm trying to be very precise. Well, it moved 50% anyway, so that can be a break of structure. Let's wait for it to give us a candle close. Okay, you see, it didn't give us a body close, right? So the structure has not broken. This just becomes our low now. It didn't give us a break. I needed to break below here with a body close. So I will still wait. So this is still my other block. Now, what is it for me here? Liquidity, which we are going to teach. This is very good in trading. I'll explain it in our liquidity class. But you see, it's forming areas of liquidity. If this body has broken below here, this would have been my new, this would have been a break of structure. And then I'll be looking to take trades from this other block here. But then this other block, what happened? It was already filled. So it will not even be valid for me. I won't do anything here. But since we did not have a body break below this level, this is still ranging from this high to this low. This is no longer considered as my break. It will just be this high to this low. So this will be one full range for me. If I draw my fib from this level to this level, where's my 50%? See my 50% here. So anything from this premium zone is where I'll be determining as my entry, which of course it will be this candle right here. This is just basic. This is just mainly a sweep of liquidity here. This is a sweep of liquidity, a sweeping liquidity. That's why I must always wait for the candle to close. This is a sweeping liquidity here. All this. So what is happening here? We can see now that price has tapped into our other block, probably taking us out. But don't forget this. Let's see if this candle closes here. What happened? It did not close above it. Right, so this is also a sweeping liquidity. And if we actually check this high here, like I also, if you can rewind the video, you see that I told you that it depends on the area. One may want to push his other block since it's resting above this high, because the market will always look for a way to sweep out buy stops and sell orders. Do you understand? So you want to trade more carefully and you want to trade with precision. Personally, for me, I wouldn't jump and put my sell order here and the market will go in and then our space start going down. No, I want to go into a smaller time frame within this region to ensure that price is making a series of change of character and all that. That it gives me an indication to go even lower. Now we've done that here. We have gotten our order block and price has played into it. But I want to stick with this my order block since it didn't close above it, or at least close within this high. It hasn't swept this high, this liquidity here. So so let's look at what happened here. This is our first sell. Let's even look at what's happening in 15 minutes candle there. This is high, swing low. break here, retest, and price is likely to go down from here. If we were to take an entry from here, we'll be looking at shorting the market from this level here, and our take profit will just be above this high. Our stop loss will be above that. Our take profit will be aiming for somewhere like here. So let's see how that plays out. What can we see? See, the market is retracing back into this level. On our 15-minute time frame here, what can we look at here? Let's look discretely. High, low, high, low. This is a break of structure here. This is why the change of character around here. This is another level again. This is another fair value gap here. So maybe one may be looking to take another entry somewhere around here, but then your target will be this low. Your target will be this low. This is the low that is entering into here. So your target will be that low. So let's say we're putting another entry here. Stop loss will rest above it. Take profit to be around somewhere around here anyways. But let's put this, let's see. That's 1:2, I think 1:2.8. Now what happened? We tapped into it here. We tapped into this entry. So we hit our TP. What do we have again? From here, we have another break of structure around there. The valid OB will be this one, but it is, if you look where you see that it's a bit mitigated here already. It's mitigated here. So we'll not have an entry there. So let's just see what price does. It has tapped into this other block again, which normally for me, I wouldn't be trading it a second time. And what happened? Swept liquidity. And this has hit our stop loss. Obviously, you can see that this market here has already done a over 1:2. This is approximately 1:2. So one would have moved the stop loss, but you can see that the entries are fit. So if we are now realistically trading off of this order block here, we are still within the daily. Do not forget. That's why entry is one of the, well, I say not the hardest, but one of the most tricky things to do when you're trading Forex. Because why? You see a lot of things that will give you confluences and all that to enter into the market, but then you see entirely a different thing playing out. And that is where we have it. Okay, this is where the current market price is as of today. It has taken out the daily high. It has taken out this daily high here. This high, sorry. It has taken out this other block high. This is the high here. So we're looking for market to do what? To come all the way to this level and see if we can have a reversal or most likely a breakout from this. So when we break out for this, the market has changed to a bullish order flow, because then to be a change of character. So I think that's about that for order blocks and fair value gaps. Let's clean up all this nicely. So do you have any question?
No.
Sam, do you understand?
Yeah.
Exactly. It's actually very easy. What you need to do is to keep practicing. If you keep practicing it, you find out that it's very easy. Entry is to enter into markets is two ways. Most people like precision. Me, I love precision trading. I love where I'm down to the last candle. If I can use 3 minutes candle and all that, and I can be taking profit even all the way down. I'll be taking profit all the way down. It doesn't really take much. This is a bullish order flow now. Just by looking at it, high, this high, put this low, put in relatively this high, this low, this low. This is the lowest low here anyways, and this is the high. What can we see again? We see that there's a change in character. Where's our order block? We can see here to here, that's a fair value gap. This is where ICT likes to take their trade-off of. You can see here to here. That's on the one side. Then some people may consider this as their low. This depends on the time frame that you're trading with. So now what happened when we broke this low? Price came in back, filled in this fair value gap here that was resting here. And what? This would have been the entry. This one now, they are just rough examples just to show you how this thing for market works. This is, sorry, it's wrong. This is an entry here. Stop loss will be above the order block. Take profit will be the low here. This is another entry, but you see that price never got here, so we could never tell. But you see price tapped into here. What happened? It came, this one is to 3.4 and it took it out. Now this is another on a bigger time frame. Maybe if we use 30 minutes or whatnot, this is it. This is another change of character here, depending on the time frame though. And what happened? Price came all the way back, built some liquidity here, came all the way and tested it somewhere around this level. So that's just how order block works and fair value gap work. But for you to be able to get into a market that has a proper order block and fair value gap, try as much as possible to understand the market structure. Market structure is one that determines where the overall price is going, with as the order flow. Then draw out a Fibonacci to get 50% of your range structure. When you get out your range structure, look for order blocks within those range that are above. If you are selling, for instance, you look for order blocks that are resting in the premium side. And if you are buying, you're looking for order blocks that are the discounted zone. So we're able to find out an order block in the premium for selling now. If you're able to find an order block in the premium, what you need to do is to now look for confluences that indicate that market is respecting your order block and is going to drop from there. That is looking for maybe like a break of structure, something like this. I'm rounding up with this class now. Something like this is now, this is within your, let me make it a bit neater. Okay. So let's say that this is your, okay, this is your trading zone. Okay. Now you now have this order block there. This is your order block in the premium. Okay. Let's say this is here. Now we're now looking for price to do what? To come into this order block so that it can, oh, sorry guys, sorry, mistake. Let's do this. Let's do this instead. Let's say this is sell. So the order block is resting here. Now this is for buying. So this is your discounted zone, right? This is your discounted zone. So all this area now is your discounted zone from here. Let's say you have drawn your Fibonacci here. What am I doing? We draw a fib from here to here. This is your equilibrium, that's the middle. So this becomes your discount zone. This is your premium zone. So since we are looking to buy this market, we are now looking for where price will come from here into the discounted zone, which is around here. Tap into our order block. So maybe something like make a first pullback. What does it do? Maybe it can come here again, change character, break here, and what? There will be a smaller, this is smaller time frame now. And look for the next order block somewhere around here. Tap into it and what? Come and take this out. So this is what we're looking for in the market. So we'll come to our next class now, which is tomorrow. I think tomorrow we're supposed to teach psychology, but we may actually take liquidity. What we're seeing tomorrow is whereby the market is retracing through our discounted zone in terms of buying now. Comes into our discounted zone, enters into the order block. Now look for areas of maybe it can build up liquidity, take out the liquidity, then break from this high, or give us like a change of character here, come back to retest this or take out maybe liquidity that was resting here, leaving maybe a fair value gap, and it'll be a new mini order block. So everything that works in the bigger time frame is just till the smallest time frame. See it here. There will be this small order block. This will not be your entry. This is why we will not be able to reduce our risk. Do you get the concept now? This is where we'll not be able to reduce our risk. So instead of putting our stop loss all the way here, we'll put it here and target this high right here. This will be our take profit. So this is just everything we have taught in 2 days. This is market structure, bullish. From this high to this low, we had internal range structure. This is the range. It's called range. From this high to this low is our range. From this high to this low is our range. From this high, well, in this market anyways, in this market is this high to this low is our range. Now from this place to this place, now where are we taking our orders? Our order blocks will now be within the discounted level, which in this particular range is going to be around here. It's going to be around here, and then we are looking for how market will retrace. Tap into it. Oh, this is me looking at a sell. Our premium level will be here. So if we're looking for a sell now, we're now looking for how within this range from this high to this low, how price can come and tap into this premium order block and then sell off from there. Sell off from that zone to take out this low. So that'll be a change of character. Anyways, so that's about today's teaching. I believe I've been too thorough, and now my mouth is paining me. Do you have any questions? Any questions?
No.
Okay, so we understand the concept of order blocks and fair value gaps.
Yes.
Okay, even with these 2 things we have done today, if you go into the market now, you start seeing some trades, but then when we start teaching liquidity, it gets more interesting, because then you start understanding like liquidity zones and why we need to spot liquidity before we even enter another block, because most times there are other blocks, there's no liquidity area. If there's no major liquidity, your trade will not fly. It's also the reason why sometimes market price will not actually come all the way back to all these areas, because once you sweep some certain liquidity and it's sufficient enough, the market just moves. So I think
gold is sweeping all the liquidity on its way down.
All right, let's go and look at it now. So thank you guys for watching, and take care.